AGM. Hey, let's see, we're going into our 8th year of execution today at Venture Capital. How many of you were at the event where we had, let's see, I guess last year about 300 people at the NASDAQ Entrepreneurship Center in San Francisco? Yeah, a few of you. And then who came to the 1,100 person event that we held in Sacramento that was an LP meeting? Yeah, a few of you came to that one too. So that was a big one. This year's a little bit more of an intimate setting for relationship development and appropriate with the times. I'm excited that you're all here to hear about what's going on with Impact Venture Capital and also our portfolio companies. I want to just take a quick second and thank the sponsors. Growco's just been an amazing partner over the last couple of years. We've been able to attend some of their events. They're providing advice and ideas for ultra high net worth individuals and family offices, and running some really innovative events across the country. So we're excited about our continued collaboration with them at their events and including them in ours. And then Inspirity's just been a great partner of our large scale events and the small scale ones. Inspirity's been a great partner, so I just wanted to mention them up front. Okay, here's a rapid fire agenda for the next couple of hours. I'm going to just provide a quick overview on some of the people on the team. Eric's going to come up and talk about the state of venture capital and corporate venture capital. As most of you know, we're pretty deeply engaged with corporate investors. We'll talk a little bit about the fund performance today. Then I have the honor of actually hosting a CVC expert panel. Sony and Natasha are here. So you'll get a chance to hear from them directly about how they think about what's going on in the marketplace and some of the industry sectors to pay attention to. We'll do 1 minute stand-ups for 6 or 7 of the portfolio companies that are in the room, where they get to give their elevator pitch, and then you can track them down after the event to ask them more questions about their plans and progress going forward. Then we'll go into the formal presentations from Konami, TestHuman, Airlink, and I think CapConnect's going to make it. And lastly, I get a chance to do a fireside chat with Jason Vita, who's here from the National Venture Capital Association. I came out from DC, so I'm grateful for him making time for us in this meeting to get his perspective on what's going on with everything from the venture ecosystem to policy and technology and investment. So his perspective is really interesting. Eric and I will close things up with a few closing comments, and that'll be the day. We'll get back to sort of networking and open up the bar, I guess. How does that sound? Great. You guys ready? Okay. It's going to go by quick, so let me just take a second, and this is the favorite part, the best part of my job is basically bragging about some of my partners. So I think many of you have had a chance to meet my co-founder and the other founding general partner, Eric Ball. I'm just going to rapid fire through this in the next slide, just to tell you a little bit about the team that I get to work with every week and how exciting and skilled they are about venture investing. So Eric was, managing $50 billion reporting to Larry Ellison, and decided to spin out of Oracle and help launch Impact Venture Capital. So I was thrilled to have him as my partner, and we went through the Kaufman Fellows program together. I think many of you know his background. Jan Geldmacher was with Sprint all the way through the $20+ billion merger with T-Mobile. Yatish Mishra sold more than $1 billion of data center companies during his entrepreneurial career. Gene Mao was a corporate venture at NetApp and is a SaaS metrics expert. So if you want to know anything about SaaS, go talk to Gene. She's really good at that. Jonathan's been paying a lot of attention to what's going on with VR. So if you want to know what's going on with VR, XR, or anything in that space, he knows a whole lot about that. He's on the board of a company called Infinitec. He sourced Arbor XR, another company that we invested in. Anyway, Jonathan's just been tremendous with regard to his industry expertise and portfolio management skills. Jen, you haven't met, many of you haven't met Jen. She flew out here from New York. She spent a bunch of years at Morgan Stanley in the alternative space. I have one-on-one meetings with her every week talking about how to access the institutional LP community as we build the next generation of our fund. She's just been a tremendous asset for our firm, so I'm thrilled. And then many of you know, I think, probably work closely with Aaron, who handles a lot of the finance, operations, all of that, a lot of the back office stuff, but also sources deals. And then last but not least, through my rapid fire overview of our team here, Pat Bumpus not only sources deals and adds value to our portfolio and helps to market our firm and our portfolio companies, but he was the lead on this whole day and this whole event. So I wanted to clap it up for Pat Bumpus. Okay, that's the team that I get to work with, and that I hope you get a chance to get to know a little bit better over the next few hours. I want to just remind those who are less familiar with the impact venture capital strategy as to how we do what we do. So we're investing at the seed level, but we're using what we think is an unfair advantage in gathering market insight from corporate investors and corporate acquirers. And so we gather this insight from these corporates. We start to develop sort of investment themes. Hey, where do we think artificial intelligence is going to apply by market or by technology type? And we believe that we're fundamentally doing two things in the seed and early stage. We are reducing the risk of seed stage investing because of the corporate insight that we have, and we are shortening the timeline to exit for the companies that we invest in. We hope to prove that out, and so that's been our strategy since we launched the firm, and now we've got literally hundreds of relationships with corporate investors and corporate M&A teams that are providing us with incredibly interesting market insight and helping us to make smarter decisions. They've sort of elevated our investing IQ. I just wanted to take a second and tactically talk about how we're engaging with corporates, because most seed and early stage firms have some level of corporate relationships. Oh yeah, we work with corporates, we work with corporates. We do it at a level of granularity that I have not seen in the marketplace. And that is, we have, each week we're having calls with different corporate M&A teams and corporate investors about where they're going to be investing by sector, by stage, what's relevant to their current corporate strategy, and we're learning a lot. A couple times a month we try to have Impact TV. Some of you might have seen this corporate venture video series that I moderate and that Pat helps to produce, where we bring on a corporate venture group and host a 30-minute interview. We have Brain Trust dinners that we've hosted in New York and LA and San Francisco and Sacramento, where we bring together corporate investors. And then we talked earlier about the 1,100 person event that we ran. That was a large-scale summit where we brought together a lot of the corporate investors to connect them with the deal flow that we have access to. So we're doing a bunch of different things with regard to corporates that I think are quite unique with regard to a seeded early stage venture fund. We've taken our team and we spread them not only across sort of industry sector down the left column there, deep tech, enterprise, consumer, and infrastructure, but also by market. We're looking at how AI applies to different marketplaces. And within each of those markets, we're trying to develop more and more corporate relationships so that we get insight into what's happening across industry. And you might imagine we're trying to build out our portfolio to fill out this bingo card as well, so that we've mitigated the risk of seed stage investing by diversifying both by industry sector and by market. And so that's the skill sets that the team spread across. Here are the logos of our current portfolio companies spread across that same chart. So you can see what we've done is we're trying to mitigate risk, obviously, through extraordinary due diligence on the front end, but by diversifying by industry sector and by market, and by leveraging different skill sets on the team. I think we built out a really interesting portfolio of companies that's now attracted more than $500 million of follow-on capital from Intel and Zoom and Qualcomm and SK Hynix and a number of others. Not to mention that a couple of companies have been acquired. Thomson Reuters acquired one of our companies. So the strategy of learning from corporates, making seed and early stage investments, and then attracting follow-on capital and acquirers is working. The timeline is long for seed stage. And what we're trying to do is figure out things we can do in 2025 to shorten that timeline as the market gets sort of a little bit more attractive. So that's kind of the overview. Now we're going to switch and put the spotlight on the entrepreneurs that are in the crowd and call on them one at a time for a 60-second elevator pitch. I don't know exactly how we're going to sort of throw them into the fire if they go beyond 60 seconds, or give them a hug, or if there's a buzzer cut. We'll have to figure, maybe I would use a little blinker light here and I'll start shining lights on them. But entrepreneurs, that they get excited about things like me. When I get excited, I go a little bit longer. But we're going to go through and give them 60 seconds each. And there's one, I found out that Gigaforce just flew in, so I want to add them, even though I don't see their logo, so I'll have them to go last. But we're going to give a rapid fire 60 seconds for each of these companies, and then we have a few of the companies that will be given a little bit more time, obviously, to make a formal presentation from the main stage. But why don't we start with Aleph? Is Aleph here? Let's see. Aleph is not here. Okay, that just saved us 60 seconds. Pat, we're back on schedule. You said I was going long, you said I went long, or I talked too fast. We're back on schedule. Okay, Ascent. Ascent is here. All right, Kevin came from Ascent.
I think, can you guys hear me okay? Sure.
Yep.
Great. Okay, thanks. So hi, I'm Kevin Kane. Thanks, Jack. So let me tell you who we are. We are a project management collaboration SaaS platform. It also leverages AI. Now I'll give the highlights, or the headlines. We helped an $80 million company go to 400 million ARR inside of 36 months. We've also, beginning of this year, we have about 200 projects in our system. Now we have over 2,600 projects in our system. Over that same period of time, we've gone from less than 100 users to over 500. And then lastly, and most importantly, we have a project with a lender that has a $12 billion market cap to help solve a $90 million exposure. Those are the headlines. So real quickly, what we do is it started with a company called Infinity Energy, one of the carve-outs that Jack mentioned, where it was a project management platform that helped a solar installer get from 80 million to 400 million. They carved that out, took it to market, and then we've been working with that ever since. So as a result of getting that new technology that's proven from an installer into the marketplace, we're actually now able to extract beyond just solar. Instead of this being a solar installer type solution, we're getting into roofing, HVAC, remodel, these other things, because that's where the market's going. Not that we're pulling them, they're pulling us. And so that's a good precursor to our lender activity. So we have this one lender I mentioned, that has about a $12 billion market cap. They have 3,000 non-performing loans. These are orphan projects where solar installers have panels on the roof, but left them, they went bankrupt. And so now the lender is left holding the bag. And so we're helping them now get that visibility that they don't have today, and the control that they don't have today, to make sure they can address those projects. Not only that, it gives us access into their contractor network, so that our customer acquisition cost is very, very low for them. So I look forward to talking to you guys. I can show a demo, whatever you like. My name is Kevin Kane, once again. Briefly on me, by the way, so you know who I am, what I do. I've been through about 10 exits or 10 liquidity events in my career. I've been in technology my whole career. Helped move an OTC to NASDAQ. And I've been a good golf buddy of Jack's. So, thanks.
Kevin, so that's the Ascent table. So if you want to talk to Kevin later on, one of the things that I think is interesting about the company is oftentimes you see these startup companies sort of meander along until they find product market fit, and Ascent has now found product market fit with some very large customers. So usually that's when a breakthrough moment happens. So that's exciting. So thanks for the update there. Let's go to device thread. Is device thread here? Okay, perfect.
Hi, my name is Swami Viswanathan. I'm the co-founder and CEO. Oh, thank you. My name is Swami Viswanathan. I'm the co-founder and CEO of DeviceThread. DeviceThread is a platform that pulls together your smart infrastructure for the hospitality industry and makes the smart infrastructure as part of the business processes. So basically, it helps improve your guest experience and also the operational efficiencies. All of us in our homes have Ring cameras or Roombas or any other such thing, and if you were to count it, you will discover that you have very many smart devices in your home and a different app for each. Now, take the same problem to a hotel. You have smart TV, smart light, smart lock, and so on, except it's on a per room basis. Now you please multiply that by 100 or 1,000 rooms, depending on what it is, and you have a giant problem that needs solving. Until now, this was only solved in the most expensive luxury properties, which spent millions of dollars to do that. What's unique is DeviceThread's platform brings this to everybody. You could be the smallest Airbnb with 2 rooms, and our platform will work for you. You can actually now get consumer-grade devices, and we'll make them enterprise class. So we've taken a while to build our solution, and we're just starting our sales ramp, and my co-founder couldn't be here because he's actually deploying a property in Tucson. So if you have any questions, please find me here. I'm here to answer everything. Thank you.
Awesome. Good job. Congratulations on the progress. That's awesome. Jean Pixel? Jean Pixel? Awesome.
I can speak Hello, everyone. All right, so raise your hand if you watch video, any type of video. Look around, basically everybody. So JobPixel is a content platform for the enterprise. We allow large companies like Cognizant, Randstad, AbbVie, the pharmaceutical company, and many others collect short-form video content from their employees, customers, and use that content in onboarding, training, advertising to boost engagement. It's the same idea of, let's just say you want to buy a mattress for your house. If you have a website that just has a simple image, you're probably not as excited to purchase that product or service And then if there's a video review, sharing how it feels, etc., it's going to increase your likelihood of purchasing something. So we work with these large organizations to turn their written content into video content that is highly engaging. We've been on a really fantastic growth trajectory, as you all know, because of TikTok and everything that is happening in the world. Luckily, LinkedIn just also released their video feed, which I'm actually excited about because my co-founder sold his company to LinkedIn. So we're just continuing to see more and more amazing things happen in the video space and the content space. So again, my name is Omar, I'm founder of JobPixel, and we are content for the enterprise.
Awesome. Thanks, Omar. Abdul.
Hi everyone, I am Wei Sun. I am the CEO of Upduo. We are AI-powered conversation-based learning platform. And what conversation-based learning is imagine peer-to-peer learning or a reflection-style learning where people are actively wrestling with the material rather than studying for a quiz or something like that. And the results of this is fantastic. So if you do a single peer-to-peer or reflection-based learn per week, like 5 minutes per week. On average, the people that use our platform get double-digit 20, 30, 40% boost in performance within 30 days. And we're able to sustain that throughout the lifetime of the company using Upduo. We are presently exploring a possible acquisition with a company called Arcade. And Arcade also has pretty similar results, but the users that use both Arcade and Upduo get 50 to 100% or more improvement in learning outcomes. So it can be up to double the results. And this could possibly result in a small funding round. So if you want to talk to us about this, I'm happy to explore with you. I'm Wei with Upduo. Thank you.
Wait, how many sessions did Upduo host like last month?
Last month, we do something like 50,000 per month and growing. And we've hosted over 2 million learning experiences on our platform today.
Pretty awesome. Yep. Score data, I think I saw last year. Yeah, talk to him for a little bit.
Thank you, Impact PC. Thank you, Jack, for having us. So, base score data, we're thankful to Jack and Jatish for investing in us in Jan 2020. Over the last couple of years, we've built an AI platform to monitor AI models, and now we've launched a platform to help companies build AI apps to improve governance. So let me give you an example of how governance might work. If you're a CEO who's here, or if you're an investor who's here, and you receive board materials every month or every quarter, one of the first questions people ask is, hey, what did I get at the last board meeting? So we allow you to summarize what's in the board materials. We allow you, using generative AI, to compare it with the last board deck or board decks a year ago. And then we ensure that there are no inconsistencies between these board materials. And last but not the least, we allow you to check whether these board materials are consistent with SEC regulations and so on. So to summarize, you can use these. You can use our tools to build your AI apps within 48 hours of receiving the board materials, and then you can you can use it to help improve, to ask questions about what's in the materials, and you can use it for promotions, and then you can use it for governance across the board. We work with companies like NASDAQ, Board Vantage, and companies like Diligent to help serve their customers. Over the last 3 months, we've built 7 apps, and if you want to see any of those apps that we've built, my team is here, and we'll be glad to show you demos.
Great, thanks, boss. Okay, Sanjeev made a special trip to get here today, so I'll make sure to include Sanjeev from Gigaforce. He's going to talk a little bit about product market fit, some customer wins, and plans and progress of the company going forward. Go ahead.
Thank you, Jack. Thank you. Thank you. In fact, we've seen everybody there, and Jatish, I think, unfortunately couldn't make it here. But just wanted to say that we are in the most interesting space called insurance, okay? And I think everybody likes it these days because every $100 the insurance companies are taking from you, they're spending $104. So that's the reason the insurance rates are going up. So there are three ways the insurance companies make money. One is premium, and the second one is the investment they do. And the third one, does anybody know the third way the insurance company makes money? Okay, it's the money they recover. So just in case of an accident, right, a good insurance company will pay you, then they go after the adverse party to collect the money. That's called subrogation. So that's what we do as a platform. So our platform, right now they built our distributed ledger. Okay, so with the multiple parties involved, so a lot of activities happen there. So our perspective, we process close to 10 to 14,000 claims a week. Okay, and a lot of big carriers are our customer today. And I have one special news we are a post-revenue company. We have a Series A open, but one good news I just want to tell you. Yesterday we closed our pilot. This was, the pilot period was 90 days. We finished in 60 days. It's almost like 300K up right away itself here. So thank you for all the support that you've been giving us. Really appreciate that part. Now, one of the things that we are doing it right now is in discussion with quite a few corporate VCs. I just came, as Jack said, right? I was at Guidewire conference, came this morning, and I'm flying back tonight to Charlotte again. But I just didn't want to miss this event today. But thank you for accommodating us. Thank you.
Congratulations. Okay, so we are going to go to the next part of the program. I always actually learn something when Eric starts talking about his analysis on the macro environment and the venture ecosystem. So I'm going to turn it over to my co-founder, Paul.
All right, thanks. All right, unlike Jack, I need crib sheets to keep myself on track, but I'm really excited to be here. Thanks, Jack, and thanks especially all of the really great portfolio company CEOs that you've already had a chance to hear from. Their stories are the heart of what we do and far more interesting than our stories. But I want to get a little drier for a moment and talk a little bit about the broader environment for venture. We're going to talk a lot today about our funds and our portfolio companies, but just an orientation to the broader macroeconomic environment I thought might be a good mood setter for us. So I just want to share some data, and a lot of this Jason will recognize because I've stolen it from the research team at NVCA. About how venture firms in the US are deploying their capital into new startups, and also how they're raising their own capital to enable that. There are a couple of separate dynamics going on in the market, and both have fallen dramatically in 2023 and the first 3 quarters of 2024, relative to where they were in 2021 and 2022. If you look at the amount of capital invested by venture firms into startup deals, that grew steadily and significantly through 2021 to reach a high of $353 billion in the US in 2021. And it stayed at roughly that same level in 2022. So these were just blowout record years for deployment of capital by venture firms into startups. But in 2023, that amount fell by more than half to just $161 billion. And it stayed at that lower level so far this year in 2024. So to put it, kind of directly, a lot of startups are really scrambling for capital right now. Now the drop-off in capital is really driven by a couple of different dynamics. First, it's an environment where VCs are less certain about raising their own capital in the near-term future, and so they're parsing it out more slowly to ensure they have reserves. And second, they're deliberately increasing the levels of those reserves because they want to hold more capital, to have it for those really remarkable opportunities, kind of saving for the rainy day of potential deals. So we have this broad trend of fewer dollars deployed into new startup deals, but there's a strong exception in the areas of AI and machine learning, where the new opportunities and the new firms are really generating a lot of excitement, and they are attracting capital. So in the last 2 years, AI alone has moved the entire broad venture market back to neutral territory from otherwise depressed territory. And this deal-making indicator that's measured by PitchBook and in collaboration with NVCA kind of shows a measure of how friendly, unfriendly, or neutral the environment is. And what it's saying is that the entire market for startups is becoming largely AI-driven. That positive force is counterbalancing a lot of negative forces. Also within the broader numbers, a really important dynamic, and one that's especially relevant to us in impact venture capital, is that the growth of major corporations in the venture ecosystem has not abated during the otherwise broad downturn. A large part of our motivation when Jack and I launched Impact in 2016 was our observation that corporates were participating in a larger percentage of venture-backed deals, while many of the more historically well-established venture firms weren't really partnering that effectively with those same corporates. I mean, the big VCs were more than happy to sell their portfolio companies to corporates, but they weren't always approaching the corporates to invest earlier in the life of those same startups. And over the past decade, the percentage of venture-backed deals invested by corporates has grown quite a bit. And the recent downtick in activity in the last year or two has not meaningfully altered that dynamic. One interesting element, if you really like to dig into the data like I do, is that the percentage of dollars invested by corporates has grown, while the percentage of deals by count has stayed flat. And so what that means is the corporates are investing more dollars per deal, and PitchBook interprets that as a flight to quality over quantity on the part of corporate venture arms. And so I think that plays well into our own thesis, and we'll talk more about that a little later. So that's how VCs are deploying capital into startups. But I want to just look at the broad market for how venture firms are raising that capital themselves. Really, what I'm getting at is how are LP investors, like many of you in this room, allocating their own investment dollars to venture as an asset class. And capital raise follows a lot of the same pattern as capital deployed in the last 2 years. The fundraising grew dramatically until 2021, set a new record in 2022 of $184 billion. And then last year, 2023, fundraising fell by over 60%, almost 2/3, and hasn't moved from that level this year. This is an even more dramatic fall in fundraising than we've seen in capital deployed. When you consider that a handful of the really largest funds are still raising capital, that means that LP allocation to the majority of venture funds, that is venture funds under a couple of $100 million, has fallen by well over that level of 2/3. There are a few factors at play at the drop in the allocation of capital by LPs to the venture asset class. First is a drop in exits and associated distributions. Venture firms overall have distributed less capital in the last year and 3 quarters than they have at any point since 2007. IPO activity has been near zero, and that's exacerbated by some of the challenges in IPO reporting requirements, the drop in activity by SPACs that had enabled IPOs to happen faster. If you want to learn about SPACs, talk to Long over there. He's the expert in the room on that. And the longer period, successful startups have waited before going public, which worked for a while when late-stage private rounds at ever higher valuations were still accessible in 2021 and 2022. But late-stage valuations by 2022 had become so high that many companies going public actually took a downtick to their valuation as part of the going public process, which really says a lot about where late-stage valuations have gotten to. Corporates also cut back on non-AI oriented acquisitions as they calibrated what new technologies they needed. And the net result is that the number of successful late-stage startup exits dipped in the last couple of years, and cash back to LPs went to its low level. Now, sentiment among the major tech firms and bankers is most expect a resurgence in late-stage exits next year in 2025. There were quotes in Fortune magazine last week. Ben Narasin at Tenacity said, next year is going to be a bonanza for IPOs. Gene France at Alphabet said in that same article last week in Fortune that he anticipates the lean-in phase of IPOs will be in Q2 2025, which is 4 months away. At the same time there have been fewer startup exits, there have been fewer LP investors. the number of LPs actively making investments into venture has dropped by 55% in the last 2 years. And it appears that the biggest sources of that dip are the major US institutional LPs, who had allocated record amounts of capital in 2021 and 2022 when those late stage startup valuations were really high. With the dip in those late stage valuations, they worry they don't know the value of some of these mature investments, and they feel overweighted to venture as a whole. And that's created a couple of voids. One void it's created is just the early stage where you never had as big a run-up in valuations as you saw in late stage. But another void is being filled by LPs who had been crowded out before and now have access. We're seeing more activity by some overseas institutions, including sovereign wealth funds, and Middle East investors, high net worth individuals, and family offices that were not over-allocated in the boom years and are seeing this as a really attractive entry point to come into venture. With fewer IPOs and acquisitions in the last 2 years, startups themselves and venture firms are finding different forms of liquidity. When you look at startups, a lot of them are turning to venture debt, which is really experiencing a boom. Tech lending in 2024 was expected to exceed $400 billion, a new all-time high. That's what that first chart shows. And in prior years, venture firms were more cautious about secondary transactions, not wanting to offer a discount to net asset value just to generate liquidity. But with less action in IPO and acquisition activity in the last 2 years, secondary firms have become a lot more active and aggressive themselves in raising and deploying capital. And venture firms are expected to set a high of $137 billion in secondaries this year, according to EquitySense. So within that backdrop, of the market as a whole, AI remains the strong exception. These two charts here from Crunchbase and CV Insights show that both on an annual and on a quarterly basis, the incredible growth in the proportion of venture deals represented by AI-oriented business models to 37%. So it's much higher percentage, and it's higher in dollar terms. This chart from Coatue shows the cumulative funding to AI startups has more than doubled in just 4 years and is now $70 billion this year in terms of just dollar amounts going into AI startups. So AI is getting the capital. And AI is getting the exits as well. AI acquisitions are really growing. The percentage and number of acquisitions by the most active global tech giants, which are the very corporates that Impact engages with earlier in the AI lifecycle, are happening. So we're seeing more money going into AI, more money coming out of AI. So what's the result of all of these dynamics? To recap, the broad markets experience a drop in investment that's driven in part by the perception of the large US institutional investors that the money they deployed into late stage venture 2 to 3 years ago was at too high a valuation. And even though the valuations were high more in the late stage than early stage, the reaction has impacted the availability of capital into early stage and thereby impacted those valuations. And this is really creating incredible low valuation entry points for investment into promising new AI startups. It's not necessarily good news for all of the portfolio company CEOs in the room that valuations are strained, but it's good news for those of you in the room who are deploying capital into this ecosystem. And even promising startups, whether AI or not, are forced to compete for capital in an environment where the US institutions are less active. And what this creates is what I think is the mother of all buyers markets. Those venture firms with capital are seeing an ability to negotiate investor-friendly terms. And we're seeing that ourselves, that's been seen in the market. And that's why PitchBook in the Q2 update referred to this year as, quote, the most investor-friendly environment in 20 years, unquote. Some people outside of the venture world tend to simplistically refer to venture as a distinct asset class. I think it's really at least 2 distinct asset classes, and the historical performance of early stage and late stage are really different. Early stage is less correlated with the public markets. It goes up, it goes down, but it doesn't go up and down in conjunction with the public markets the way the late stage does. and it's offered a higher return over long periods of time. Early stage hasn't been subject to the bubble valuations that we saw in some late stage, and I haven't seen an environment this conducive to deploying new capital yet in my career. My last point really is that history indicates that the best vintage years have tended to follow this same pattern. If you look at bubble years of crisis, they've tended to be followed by years where the attractive entry points make for good vintage years in the long run. After the crash in 2007, the seed class of 2008 saw several new startups thrive in a tough environment. Those included Uber, Square, Airbnb, Lyft, Groupon, Stripe, all got their seed rounds in 2008. We think the seed class of 2024 and 2025 faces some of those same characteristics, and that this approach of investing at lower macro valuations increases the probability of success. And so that's why we think this is a really promising entry point into early stage venture. And I want to pause there and then transition from this broad market, where the broad market dynamics, and talk a little bit about our venture fund here. So in this session, I want to narrow the focus to how we go about building our funds and what the performance is so far in our first two major funds. The defining characteristics of our firm has been and continues to be along the lines that Jack has reviewed, that first, we invest early stage. We typically invest in a seed round, and we're often the first institutional investor, and we frequently take a board seat to help advise for the future. We will invest in later stage rounds, but we rarely do so unless we are already investors from the seed round. We feed our winners, and we maintain reserves for follow-on investments for those companies in our portfolio that are hitting their metrics. And we sometimes go beyond our fund reserves to accept an aggregate investment in individual companies, co-investing with our LP base and allowing them to use the fund as a source of deal flow for their own individual startup opportunities. Our second defining characteristic is that we invest in applied AI. We started applying an AI filter to our deal prospects at the birth of Impact 8 years ago, before progress in large language models made AI a buzzword kind of throughout the ecosystem. So we like to say that we were investing in AI before it was fashionable, and we didn't just show up and discover this new model. And we think that that experience will help us pay dividends in an environment where a lot of people are just getting started in investing in AI startups. And then our third trait, and the one that Jack's already spent a little bit of time on, is our real emphasis and focus on collaboration and co-investment with major tech corporates. It's really a key component for us. There are other early stage VCs and some others that focus on AI, but not many that have focused on AI as long as we have, and not many that are as dedicated to serving and partnering with corporates as we are. So how has this played out for us so far? Well, we started Impact in 2016, started accepting LP investors in 2017, and it's really great to see some early investors that go all the way back to January 2017 with us, including the Dahl family, University of San Francisco, SK Hynix, Heejin is here, Juan from Westlake Ventures, Eric and Chuck from GrowCo. They're all in the room, and all of them have been with us since the very beginning, and we really appreciate that. Since 2017, we have invested $18 million in over 20 companies in our first fund. And through a combination of successful exits, like when we saw Pondera sold to Thomson Reuters in 2020, and also secondary transaction, as when Fund 1 sold shares in Konami to a later stage SPV in 2021 and 2023, we've returned almost $7 million back to Fund 1 investors. We co-launched with Fund 1 an affiliates fund, enabling nonprofit donors to contribute investments in lieu of cash, making nonprofits the LPs, and those investors have received an additional $1 million in distributions in the same underlying investments. Now in Fund 1, we revalue the portfolio companies every quarter. In most cases, the value simply reflects the most recent financing round. Where there have been no round in the prior months, we apply judgment to mark investments up or down, according to the best metrics that we can bring to bear. And we have a really good team for helping us figure out what those metrics are for a particular business model. As of the most recent quarter end, as you can see here, the Fund 1 portfolio is valued about 2.7 times its cost basis, And much of that value is driven by the top 4 positions. And in each of those cases, in those top 4 positions, those companies anticipate up rounds in 2025 that we think will increase this multiple in Fund 1 in the coming year. Just a couple of additional metrics in Fund 1. These companies have gone after our own investment to raise an additional aggregate of $500 million combined in new investment, and that's come from other venture firms, corporates, and other large investors. I'd like to say that after angels, we're the second leg in the relay race. So it's like friends and family and angels, and then it's us, and then we bring in corporates, we bring in larger VCs, and we hand the baton off to the later stage in the startup's life cycle. Since 2017, the aggregate revenue of Fund 1 companies has evolved to over $160 million, and we're going to recount this soon. We think this number is going up, and we're going to retally it before year end. And we work with our companies to get them from pre-revenue to revenue to growth. The net IRR on our return on our Fund 1 is about 15%. That does exceed the S&P return over the same period. It's expected to increase in 2025. And our loss ratio, which is currently about 25%, is significantly below the market average, which runs more like 80%. This is a little bit of an eye chart, so I don't expect you to see every line, but I just want to use this list of our positions in Fund 1 to make the point that, like Peter Thiel described in his great primer on venture, 0 to 1, venture investing is a phenomenon driven by the power law, which says the top handful of positions are going to represent a disproportionate share of the return. That's usually true for venture firms. It's certainly also true for us. And the way that I state this a little easier to understand is strikeouts don't matter as much as long as you hit the occasional home run. And what it means is that we as investors are chasing outliers, not just a company that might return its own capital, but a company that has the possibility of returning the capital for the overall fund. Our top 5 positions account for over 90% of the value of the Fund 1 portfolio, and 3 of those 5 positions have CEOs that you're going to hear from in 20-minute presentations as soon as I stop talking and turn it back over to them. Fund 2 is a younger fund. We launched the fund just as COVID was starting around 2020, and that delayed the fundraising and the deployment and the progress somewhat, such that the fund behaves even younger than the vintage year would suggest. This is happening across all venture funds that were launched in that time period, and it's happening to us as well. And all it means is that it's taken longer to get the fund to generate dispersion. By this age in Fund 1, we had some companies trending noticeably upward and some trending downward that didn't work out and we wrote off. In Fund 2, a higher percentage of companies at the same age have not trended upward or downward. And so we're still having a block of companies valued more, near that 1.0 times cost basis. But then it started to change just in the last couple of quarters. Gigaforce, you heard from Sanjeev, they're using blockchain to provide a guaranteed accurate single source of truth in the insurance sector. And they're finding that these efficiencies that they're created are very attractive to insurers. The company's getting some great traction. Based on relationships that we had with Sanjeev, particularly with our operating partner Yatish Mishra, who couldn't be here today, we were able to make an initial investment when it was more or less still just an idea at a relatively low valuation, and that's allowed this progress, even still relatively early in its life cycle, to be the first company in our Fund 2 to get to a multiple over 2x. And so we're really excited about Gigaforce. We're also excited about Cap Connect Plus, which started on a proverbial cocktail napkin at a lunch attended by the current CEO and myself in 2019. That's a company that's built an auction platform to get a true clearing price for issuance of debt by corporates. And they had their first live transaction yesterday with Walmart issuing $100 million of commercial paper using the Cap Connect Plus auction platform at 7 a.m. yesterday morning. So that team is a little wiped out. I'm hoping they still make it today, but I think they're. We'll see. We'll see how that goes. So while we don't have yet the full outlier effect observed in Fund 1, we note that even these 2 companies alone are already representing about half of the value in Fund 2. And so we think Fund 2 is starting on that same trajectory that we've seen in Fund 1. The last slide that I'm going to touch on in terms of performance is just talking about co-investment and the evolution of co-investment. We really feel that it's not just about what we put into our companies, but what we can bring to our companies from our network to help the portfolio companies and to help the investors. We work with our companies to recruit new investors for subsequent rounds. Our portfolio companies have received over $500 million in funding after our funding in the aggregate. This makes our funds a great source of deal flow for investors in our fund that are seeking to identify good candidate individual startups for one-off investment. As an investor, you can leverage our due diligence for your own use, and we encourage you to do that. You can also dilute the management fee you pay us by allocating that over larger investment on a follow-on basis. And we often simply invite our LPs to invest with us in the companies, in many cases without fee or carry. Now we do, for rounds that are oversubscribed and or large, we do form SPVs to take advantage of our pro rata investment rights. In that case, we do form an entity with fee and carry. And we've raised $28 million to date in SPVs for our more mature and successful early companies. And we anticipate continuing to do that and continuing to offer that opportunity to those of you who invest in the funds. We're going to talk a little bit more about this later, but the natural evolution of going with funds that are highly diversified over 20 or 30 companies, and then individual SPVs, which are one-off bets on single companies. We're developing a hybrid right now, which is a growth fund, which lets us supercharge investment in the crown jewels, those companies that have generated the most traction and the most success, where you're not making a single one-off investment and kind of on a binary yes or no outcome. You're getting some diversification, but you're not getting it into a blind pool of investments. You're getting it into a very discrete and narrowly defined pool of the most successful companies. And we'll tell you more about that in a little bit, but that's my teaser for you. So that's where we are in terms of fund performance. Thanks for listening. I want to turn it back to Jack to talk about our corporate venture panel.
Great job, Eric. I'm going to ask G and Austin, two friends from the corporate venture community, to come up on stage with me. So I think they're both here, right? G and Austin. Oh, come on, guys. We are developing a broad network of relationships with corporates, as we've talked about quite a bit. In addition to Heejin Chung, G and Austin are two of the people that I've learned just a tremendous amount from over the years. G was at Dell, then Micron, now Hitachi. So we're going to talk a little bit about her background. And then Austin is the sort of exact opposite of that, right? Been at Sony for like a century, right? And so he's got tremendous, arguably one of the most dedicated and experienced corporate investors in the marketplace. So thrilled to have both of you here. Since I'm sitting for most of the day, I might stand while I ask questions and sit down if I get tired, if that's okay with you guys. Let's just kick things off with just introductions, a little bit about your background. G, you and I developed a friendship in the Kaufman Fellows program, and then I just sort of followed your career as you were sort of recognized as corporate investor, rising star, and some of these other things in the industry. And you've sourced 3 really interesting investments for impact venture capital and co-invested alongside of us in many of those at each of the 3 different corporate investment arms that you were at. But anyway, talk a little bit about your background.
Absolutely. Thanks for having me, Jack. It's always a pleasure. My personal background, I've been in the tech sector now for close to 25 years. I've done everything from product management, product marketing, strategy and M&A. I've done a stint in institutional VC, like Jack's fund, and now for the last 6 years or so, I've been in the corporate venturing side. Prior to joining Hitachi, I was with Micron Ventures, the corporate venture arm of Micron. Joined Hitachi last year to set up their presence in the Valley and lead our investments out of Silicon Valley. So,
pretty significant difference between your role now at Hitachi and the early days at Dell, right? I mean, pretty significant difference in your role and responsibility and level of authority and those kind of things, right?
And Dell was also a lot more focused on strategy and M&A, so I got to sit on the other side of the table and decide which companies to buy or help in the acquisition process. So I think it's given me a unique, and I have to say I've worked in really large companies or really small startups. So it's given me a real good taste of what it's like to build a product hands-on. It's given me a sense of what is it to sit on the other side of the table, negotiating an acquisition or thinking about what are the things that are important from an acquisition perspective. And so that gives me I hope, a unique perspective as an investor when I'm investing on behalf of a corporate, because I'm able to look at how corporates think and also how startups think and bring that lens to bear.
Pretty well positioned to add value beyond capital with regard to visibility to M&A and those kind of things.
Exactly.
So that's really
That's
helpful. Austin, so it is 20 plus years, right?
It is,
So,
right.
I mean, you're a bit of an industry icon in the
I wouldn't
corporate
call
investor
that, but
space. But
maybe as I was telling some folks in Japan, actually, they were saying, oh, so I said either I'm too old to take a risk or I'm just having too much fun. They said, oh, I hope it's number 2. I said, so yeah, I've been in the Valley. So well, as you could guess, I'm originally from India. Went to school in Michigan Tech, and actually there was Kellerman here you never meet people from Michigan Tech, but he went to Michigan Tech, so, and he and you went to Ross together in Michigan. So I went to school there, moved over to Silicon Valley, worked at, I had an opportunity to work at a startup company, but coming from India, I said, hey, shouldn't take risk. I worked for a larger company called Xerox. I worked for about 3 years, got frustrated, left, worked for a medium size. Then I went to a startup company. So did my stint there. The company didn't go too far. I was just a normal engineer at that time, and then worked for a kind of a larger company. And then actually I got a job at Sony in the engineering side back in the late 90s, and I lasted 1 year. it was frustrating working for a large company. So I thought that my DNA to work for a large company is not there. So I left, and then I did my own startup. And I did my startup, was on it for about 3 years, and I did a deal, and that's how I came into the Sony venture team back in 2002. So I've been at the CVC's thing for the past 22 years now.
Corporate thing clearly works for you.
So I've been on this side of the table now, so I don't have to deal with any operations day-to-day stuff. The role that I played at Sony is pretty interesting, and that's what's kept me going and it keeps saying. At one end, I head up this venture team that is looking for the latest innovations that's going on. On the other side, actually, I kind of straddled strategy, and I work directly with headquarters in Japan. So a lot of the new initiatives that come in, I tell folks, we have a lot of influence on it. We don't control. We can tell them this is the areas to do. Some of it they listen, some of it they don't. But that has kind of led to looking at what goes on in Silicon Valley has led for Sony into many new areas. Cloud gaming is one of them. We are leaders in what we do in the gaming side console, but given the network capabilities, cloud gaming. So that's what we did. We looked at a bunch of startup companies. We acquired Gaikai in 2015. So that's how it's kind of building up a combination of strategy, working there, or not dealing with the issues of day-to-day operation, and then running the venture fund. And I can talk more about the venture fund itself, but because
sure, no, that's helpful. Refresh my memory though. I think you're seeing 8,000 to 10,000 investment opportunities a year. What's the deal flow pipeline look like at
so it's about 4,000, 5,000, because we've got a worldwide team, and so we have folks in US, Japan, Israel, Europe, and also now in India, and actually most recently we put one person in Africa.
Okay.
So overall the flow is pretty broad. Selection processes, the painful part.
So for the entrepreneurs in the room, part of what I want to do during this panel is give both the entrepreneurs some insight into how these corporate venture investors operate, and then also for the investors in the crowd, we're always looking to extract knowledge and market insight from you to make us sort of smarter investors, sort of elevate our investing IQ, right, and looking at things that might be relevant. So let's first focus on the entrepreneurs, and maybe Austin, you could comment. Can you talk a little bit about sort of the typical due diligence process and sort of you're sourcing a deal, what's a typical due diligence process, positioning and sponsorship, sort of maybe just briefly walk us through an entrepreneur knocks at your door and sort of what happens then, whether that's an email introduction from a VC firm or source from some other credible source, what's the process?
So the two ways that we approach it, one is a proactive, a reactive way where, someone like IDC or someone Coastlaw sends us a deal, we kind of look at that and then match up with the focus areas that we have. The 5 focus areas are entertainment technology, deep tech, which kind of overlaps with what we all do, enterprise SaaS, and then fintech, Web3, and then the last one is climate tech. So if we match that a bit well, that's a better chance of doing it. The other one is proactive. If we start looking at a certain space that potentially our strategy business group has an interest in that case, we use the pitch books and the CD insights and everything else to scan the whole space and pick the 5, 10 companies that we look at. Proactively.
Investment map.
Yeah.
Where's the heat check
Yeah.
out there? Yeah.
And the process-wise is, that's why I managed to do 20 for 20 years. We transformed how we started to where we are today. So previously, it was always the business units has to give the thumbs up. So even though we were headquarters, we had a budget, we could, I could have authorization to write even a 500K check. But if the BU didn't give a thumbs up, and sometimes, I'll just be blunt and saying, either they don't get it, or either they're doing it themselves, or a bunch of stuff, it would take forever. And that was the frustrating part in the process. Long process. We ended up missing a lot of early stage companies because they're just too early for a $10 billion business.
Mm-hmm.
So that's where we pivoted in 2016. We created Sony Innovation Fund. It's a proactive fund, 100 million, no business unit input. It's our interest in looking at the signals from the industry.
Operating independently.
Well,
Sony has the
operating,
option.
I'm still a Sony employee. I still
Yeah.
get the bonuses and stuff like that. But it's operating means the decision is independent.
Yeah, I see.
We don't have anyone from the business unit on the IC. So that frustration that was there for us, and particularly the startups, which took a long time, has gone away.
Yeah,
We
I
can
see.
do things within 6 to 8 weeks.
Okay. Okay. Gee, can you talk a little bit about sort of investment strategy and due diligence process, or just sort of mostly speaking to the entrepreneurs who want to get into Hitachi and try and connect with you?
Absolutely. Kind of similar to Sony in that we have 2 approaches. One is we're very thesis driven, so we do deep dives on specific areas that we kind of map out. It doesn't necessarily come from the business unit or Hitachi per se, but it's areas that we identify as interesting that we want to start tracking. So we had done that with generative AI early before the whole craze started. We did a deep dive and then we've done mini deep dives around the area. Historically, those deep dives were more, we would do it and then we'd share it internally with Hitachi as this is what we see in the market. But in the last 6 months, one of the changes is we are trying to also establish ourselves as thought leaders. So we've started putting out blog posts based on our deep dives that we've done. So
Do you call them internally deep dives or like investment themes?
we call them deep dives, and then we call them mini dives and deep dives.
Okay.
So like the generative AI led to like a bunch of mini dives around LLM ops and things like that. So our most recent one was around agentic AI, and then we did one on data pipeline. We have also done one on physics AI. We're doing one on physical AI. So as you can see, AI is a theme, as Eric mentioned in his previous talk. So in the process, we proactively reach out to companies that meet that criteria. We build out a landscape of what we see, and then we proactively reach out to companies in that area. That's one. And 2, we talk to a lot of VCs like yourself to see if there's potential for, now that you know what our interest areas are you seeing companies? I see some co-investors or potential co-investors in the room here with whom we have engaged, frequent conversations on potential deal flow. So we do a lot of comparison of notes and exchange deals and intros as well. So that's another way. And now because we've started putting out our sort of blog posts, we are seeing a lot of inbound interest too. Because in the past, Hitachi is not very well known. I mean, people know about Hitachi, but Hitachi Ventures was not very well known in the Bay Area. So people were like, oh, we didn't know you guys existed. So now we're doing a lot more of that evangelism.
Elevating your profile,
Exactly,
attending
yeah.
events, speaking, other
Exactly.
things you're doing to elevate the profile specifically?
It's mostly 2 things, right? It's working with entrepreneurs, showing value, how we can bring value to the table with entrepreneurs, and then when we bring on or when we go into a very contentious round, which is over allocated, Then we allow the founders to talk to other founders that we've invested in, so they hear firsthand the value that we bring to the table. And now we have people fighting for us in their boardroom when there's oversubscription.
Can you talk a little bit more about sort of value beyond capital, and then maybe I'll ask you that same question, Austin. What I've seen is corporate investors provide tremendous market insight, sometimes co-development resources where they actually help to complete a product. I've certainly seen them become a customer, issue a purchase order. In some cases, Thomson Reuters is taking some of these companies and sort of if they're selling some kind of Gen AI software that they'll distribute out to their entire network of relationships with accountants and attorneys. So it's like a sales channel. Obviously, a capital source and then a potential acquirer. Is it across that continuum? Sort of where do you focus and what do you think? I've seen you add tremendous value with mentoring founders and providing value. But where do you see Hitachi generally and you specifically?
So also I'll clarify, we don't require any BU sponsorship. We are set up more like a LPGP kind of setup. The investment decisions are done by the 5 partners, that's the investment committee. So we are able to move fast if needed. So in terms of value, I think that we actually add a lot more value. There have been many investments that I've done where there was no BU sponsorship. They basically said, we're agnostic, I don't see how it's valuable. And then in a subsequent round, one of our portfolio companies, NVIDIA, came on board, and now they're all fighting to get, intros to that company. All right. So, but where do we add value? It's Hitachi is a company that's north of 100 billion in market cap, has over 700 business units, and every unit is like a silo. They have their own strategy, corporate development teams. It's very hard. Even when I talk to somebody, I find something new about Hitachi every time. So for a startup to navigate this landscape is super difficult. And that's what we try to help alleviate.
You're
or
an
manage.
internal champion
exactly.
that helps to get them into this.
Absolutely.
Okay.
So there's one company, for instance, is an agentic AI company. They were, put in front of a HR team for a specific use case they were looking at. They actually turned down the company because they didn't use the word agent in their proposal. So they thought they were not agentic enough. This is a case of miscommunication. So I stepped in, I said, you don't have to make the investment in the company or in the product, but at least I want you to give them a chance because this is as agentic as we get. Because they're doing agentic mesh, a bunch of agents working together. So just a startup that wouldn't have had, that would have been essentially cut from the process. We stepped in, managed that miscommunication.
A little shared vocabulary, market insight, and a little pivot to make sure that they were.
Now they got through the POC, and I was told that it was of the 3 POCs that was done, that it was one of the best POCs that they've seen. And fingers crossed, if the pricing works out, they hope to move forward with this company, right? So now Hitachi is a customer. Another example, a co-investment of ours, Zaba. So Hitachi has JR Automation, which is a robotic SI, and then we have Hitachi Rail, where we actually manufacture rolling stock. Rolling stock, which I didn't know when I joined Hitachi, is actual carriage, right? The actual physical carriage. So Zaba actually is working with a lot of aerospace customers. So I thought that there could be a lot of value given that we have a robotic SI in-house and a rail company in-house. The robotic SI was dealing with their own problems. They heard the first pitch, but they were not actively engaged. We did the seed regardless of their commitment. And then over time, in the last 6 months since we invested, we doubled down and we led their seed extension, which we're very happy to have you guys on board. What we did is we went to Hitachi Rail and said, if this works for big aerospace companies that are building aircrafts, it should work for you guys, right? Got them in front of the Hitachi Rail folks. Hitachi Rail basically said, this is a game-changing technology, but how is this 12-person startup going to support Hitachi Rail? We said, well, Hitachi has this robotic SI in this other part of the broader Hitachi universe, brought the 2 of them together with the hope that JR Automation can be an implementation partner. So it's kind of a win-win-win. And so a couple of examples of how we are trying to connect the dots and add value.
Austin, you realize there's real pressure on you, right? Yijin Chung has sourced one of our top performing companies. G is sourced one of our top performing companies, and we're still waiting.
Oh, because
What's going on?
I'm
We need a
happy
little
to
bit
keep sending you emails. Actually, we should be, because, I should say why we need to send and we need to do more, power on a little bit more, is, we don't, after all this stuff, by the way, we have a $200 million Sony fund, which is the Sony stage fund, 250K to 2 million. But actually we have $380 million, which is structured as a GPLP fund, which has all external LPs from Japan. So there we are driven for financial returns. It's not the typical CBC, you can take it easy. For the Sony side, it's a longer term strategic value that we can bring in. So we would be happy to take a lot of the early stage funds, but we have still not managed to reach a stage where we need rounds. So we definitely want to partner with funds like yours, which can lead and we can come in and
Sure.
add value to it.
And when in the oversubscribed rounds, when speaking to the entrepreneurs that are in the crowd, if you find yourself with access to an oversubscribed round and they're evaluating bringing Sony in and putting them on the cap table, is there something specific? I mean, obviously Sony's brand provides a little bit of the halo effect if you're involved in a company. Is there something specific outside of sort of the brand affiliation with a young company that you find yourself providing as a way of adding value beyond capital?
I'm just being honest about the young companies, because I was an entrepreneur, you might as well not listen to the CBC bullshit and just go for it. Is my thing is, you have to be honest, there's no way we can structure a deal between a 5% company and a business unit. I'm being very honest about it.
Yeah.
But having said that, we can open up doors with, as you reach the Series A, Series B, we are happy to do that. And that's what we've done. You know, there's a company, if any of you do reCAPTCHA for Google, they're competing with that. It's called Arcos Labs. PlayStation has it. To have a PlayStation logo on that, it's like their valuation goes up there. So does Xbox. So we do partner with other corporates. We don't compete with that. So there's value that we can bring in there. In addition, all the LPs for any market entry into Japan, we are more than happy to use a resource. There we actually even some early stage funds. We can help them to get into Japan, help them to get into work with some of the CBCs in Japan. So a market entry into Japan.
Okay.
I'm talking with the US portfolios here.
Yeah.
Market entry into Japan is a given. We're
Yeah.
happy to do that. We have a footprint across the board, so wherever where my team has footprint, we're happy to help there. What we cannot commit is say, so and so your product is going to be sold through the Sony channel in, I don't know, in Bulgaria.
Yeah.
Those commitments from Sony business units we do not take up. We'll influence them, but we control as long as we guys.
Okay.
And we are very upfront with the portfolio.
Okay.
Yeah, and to echo Austin, right, we cannot be your sales team for the entrepreneurs. We can open the doors, we can make the introductions, we can resolve any communication issues, but at the end of the day, the selling needs to be done by the team and their product.
Yeah.
And set expectations, actually, that's the key thing, because there's too many times, like a hardware company, which you guys have to, they think it's in beta. If you go to a company, particularly a Japanese company like a Sony, they'll think it's pre-alpha. And they may be pretty right. In software, it's a different stage. You know, Japanese are too conservative, sometimes it's not good. But you need to set, this team, the CBC team, if they don't do it, they're not doing a good job. They need to set the expectation that not there'll be disappointment of either the business unit side or the startup side.
Or a lot, your
Or some
comments.
VCs would be pissed at us.
Yeah, your comments are well received because the opportunity cost of a 5-person company spending a lot of time thinking the sun's just around the corner from signing a deal with them. I mean, they're burning cycles, burning runway, and so it can be really painful. So appreciate the candid discussions. Let's turn our attention to the LPs and investors in the crowd and sort of give them some insight. If Sony over the next 2 or 3 quarters is going to make an investment or an acquisition in a particular industry sector, is there something that's really got you excited in a particular industry sector where you anticipate high likelihood in making an investment or an acquisition from the Sony platform in the next few quarters?
So Sony in general is not an acquisitive company, so I'll just put that out. We have done some recent ones in the gaming side and studio side because IP is a big thing for us. But technology side of it, we have not done too many acquisitions. But on the investment side, I can say is we are pretty bullish about the whole deep tech side, you know, which is very, very broad. You know, we looked at investments in from materials to display to optical networking to processors to be able to do it. It's a long haul. Deep pockets are required for it, but and then the whole Gen AI side. I personally, again, I shy away from representing Sony business. There's no press here, so it's okay, but we are press people, crazy, corporate communication people. So we have to be careful because if Sony Ventures says something about Gen AI, they're related to Sony business units interest, which we can do because there are a lot of content side, there are a lot of issues. What the Gen AI is going to do to the content industry, and we own a lot of content industry now. So for us, I think the SLMs, the small language models, will be pretty interesting. I feel anywhere that is some company has access to unique data sets, whether it's working with a particular enterprise or this, data is going to be the main thing for the training side, and the ability to get into existing workflows. Because those are the two things that will be the hurdles for startup companies. But given the same access to a startup versus a large company, I think the startup will succeed.
Yeah.
If given the same access. But the access to the workflow and access to the data, legal data, but that's again, we are concerned about how data and our content is being used.
Okay. Gee, what's our next co-investment?
Quite a few. So we are quite bullish on the agentic AI space.
Yeah.
We put out something 3-4 months ago, and we were already in the process of making an investment in that area. But broadly speaking, data center as a theme is picking up across Hitachi. So we're actively looking at the data center space. And the data center, funnily enough, I think represents Hitachi very well because it covers everything from industrial side of manufacturing stuff to energy. Hitachi has a big presence in the energy side. They build actual transformers. And then also some of the infrastructure to support the data center, like chillers and cooling, and then actual infrastructure that goes into a data center, like storage and systems and so on. So we are looking at that data center space. I'm very much focused on the digital transformation or DX side. I have colleagues or partners who are much more focused on, I would say, green, and then we have another partner who's focused on the industrial side. So I think data center is one of those topics that straddles all of that. We are starting to look at semiconductor space again. We had sort of held off on that, or we're quite slow, but we're readdressing that space. And again, AI, and looking at data, we think that the modern data stack is not modern anymore. So there's also a lot of push towards, with issues around data sensitivity and so on. We are hearing a lot more corporates talk about bringing the data back in-house as opposed to cloud. So we're looking at what could a new data architecture look like and what are the plays there.
Okay. Well,
I think just to add to it, given we are an entertainment company, we are heavily looking at the intersection of entertainment and technology. The new forms of more of an interactive way of entertainment. Obviously, the content is there both on the gaming side and also on the movie production. The ways to enhance how you do movie production, the virtual production, stuff like that. So that's one area. The second area, which is also the whole Web3 space. I know it's if you leave crypto aside, Sony's focused more on the blockchain side, and so we launched, which I'm not sure how many people here, we launched the L2 in Japan. And so now you can imagine we're building everything around that layer 2 to be able to do it. So Web3 in a very controlled, very more focused on the entertainment side at this point.
super helpful. Thanks for the marketing insight. Okay, I know we need to wrap up. So speaking of data centers, we have Cornani coming up to present next, I think. But let me just ask one last sort of candid piece of advice for us. So we're always looking to expand not only the number of corporate investors that we're working with, but the depth of the relationship. We've developed a tremendous friendship with you guys over the last 5, 6, 7 years, maybe longer in our case. Any closing ideas or advice for impact venture capital or seed and early stage firms like ours that are looking to broaden the number of corporate investors in their network and deepen the relationship? How can we best add value to what you guys are trying to do going forward?
I think from my perspective, our deal flow is so much, but if that relationship, and we should talk, we should do a regular cadence of catch up. You know, ad hoc is okay to send deals for doing it. Knowing what the corporates are looking, because we can share with you what we are looking for, would be important. So that relationship with the corporate is important. There are a lot of emerging managers. If you think about your smaller fund, there are a lot of them. But we like working with the smaller ones because there's better relationship. Even if the big ones, even if you put in 10 million in their fund, you won't get the time of the day for doing it. But I think that relationship with smaller funds like yours is very important, and exchanging information, and it will be a bi-directional information exchanges.
Sure.
I think that's what you all should do more.
Yeah, yeah, thanks for that. G?
I don't know if the other corporate VC colleagues in the room agree or not, but I'm seeing a lot of value coming from, you know, younger funds like yours. Younger meaning early stage, in terms of helping their portfolio companies. I feel like for larger funds, and given there's a closed room, I'll say it very bluntly, for them it's all a rounding error. You know, given the size of fund sizes these days, if one doesn't work, they're willing to move on to the next one. So in terms of commitment to helping the portfolio company, I think I'm seeing that is not a very strong value add for some of the big funds. Their value add seems to be, oh, we have this platform, you know, recruiting and all of that stuff, but day-to-day hands-on support, I think you guys are doing a lot more. And to Eric's earlier point around corporates now putting more money but in fewer deals, we are trying to be that value-added investor, right? We don't come with that grand cachet of some of these large funds that are institutional funds. So we are having to show our value every step of the way. So I see working with, you know, partners like you as super valuable in elevating the our portfolio company, and so I think we should keep doing that.
Thanks for that feedback. Join me in giving them a round of applause. And then I'm going to defer to Pat. Are we going to take a 5-minute break, or am I going to call Kornami straight up to the stage?
5-minute break, and I'll come back to the portfolio company.
Perfect. Okay.